Most people open a chart and see noise. Price goes up, price goes down, and none of it seems to mean anything. But every candle you are looking at is the record of a fight. Buyers on one side, sellers on the other. The shape of the candle tells you who won. In the next 20 chapters, you get the patterns that matter most, and every one of them the same way. What it looks like, what it actually means. 3 rules before you trust it, and the mistake almost everyone makes with it. So here is what is coming. 20 patterns. A few of them you will recognize. Most of them will change how you read the next chart you open. We start with number 1. It's called a bullish engulfing. 2 candles, not 1. First, a down candle. Sellers still in control. Then an up candle opens lower and closes above the entire body of the down one. It swallows it whole. Here is what that actually means. Everyone who sold on the previous candle is now underwater. To get out, they have to buy back. And price closed higher anyway. That is not a bounce. That is a handover. 3 rules before you trust it. 1. It has to follow a real downtrend. In sideways chop, it means nothing. 2. The up body must cover the down body. Wicks do not count. 3. Volume expands on the engulfing candle. And the mistake almost everyone makes. Entering while the candle is still forming. It is not a pattern until it closes. Entry above the high. Stop below the low. So that is the bullish engulfing. 2 candles, 1 decision. Number 2 does the same job with a single candle, and almost everyone buys it 1 candle too early. It is called a hammer. 1 candle, a small body at the top, and a long wick underneath. Price fell hard during the session. Then buyers took it all back before the close. Here is what that actually means. The long wick is a record of failure. Sellers pushed price down there and could not keep it. Every one of those low prices was bought. That is not a bounce yet. That is a rejection. 3 rules before you trust it. 1. The wick has to be at least twice the body. 2. It has to appear after a real downtrend, not in a range. 3. The close should sit near the high of the candle. And the mistake almost everyone makes, buying the hammer the moment it closes. A hammer is a question, not an answer. The candle after it decides. That is the hammer. A rejection written down. Number 3 needs 3 candles to say the same thing, and the middle one is the part people skip. It is called a morning star. 3 candles. First, a long down candle, selling in control. Then a small candle that gaps lower and goes almost nowhere. Then a long up candle that closes deep into the first one. Here is what that actually means. The middle candle is the pause. Sellers finished, buyers had not arrived, and price simply stopped. The third candle is the answer to that question. 3 rules before you trust it. 1. The middle candle should have a small body, ideally a gap. 2. The third candle must close above the midpoint of the first. 3. It has to follow a real decline. And the mistake almost everyone makes, calling it early. 2 candles are not a morning star. Until the third one closes, you are looking at a down candle and a pause. That is the morning star. A handover in 3 parts. Number 4 is the opposite. Nobody wins it at all. And that is exactly what makes it useful. It is called a doji, and it is 1 candle. Open and close land at almost the same price. The body is a line. Buyers pushed, sellers pushed back, and the session ended where it started. Here is what that actually means. A doji is not a signal. It is a pause. In a strong trend, it is a rest. After a long run, it is the first sign that one side is running out of orders. 3 rules before you trust it. 1. The location decides everything. A doji in the middle of a range means nothing. 2. It has to end an extended move, not start one. 3. The next candle is the actual signal, not the doji, and the mistake almost everyone makes, trading the doji itself. It tells you the market is undecided. It does not tell you which way it will decide. That is the doji. Nobody won. Number 5 is what happens when one side reaches too far and gets sent back before the close. It is called a shooting star. One candle, a small body at the bottom, a long wick on top, appearing after an advance. Price pushed to a new high during the session. Then it gave every bit of it back before the close. Here is what that actually means. Somebody was willing to sell everything up there. The high was reached and rejected inside the same session. Everyone who bought near that high is now underwater, and most of them will try to get out at break even. That creates supply above you. 3 rules before you trust it. 1. It has to follow a real advance, not appear inside a range. 2. The upper wick should be at least twice the body. 3. There should be little or no wick underneath. And the mistake almost everyone makes, shorting into it the moment it closes. A rejection is not a reversal until price confirms it. Wait for a candle that closes below the body. That is the shooting star. Reached and rejected. Number 6 is the mirror of where we started, and it is not as symmetrical as it looks. It is called a bearish engulfing. 2 candles, not 1. First, an up candle. Buyers still in control. Then a down candle opens higher and closes below the entire body of the up one. It swallows it whole. Here is what that actually means. Everyone who bought on the previous candle is now underwater. To get out, they have to sell. And price closed lower anyway. Supply overwhelmed demand in a single session. 3 rules before you trust it. 1. It has to follow a real advance. 2. The down body must cover the up body. Wicks do not count. 3. Volume expands on the engulfing candle. And the mistake almost everyone makes, treating it as a simple mirror image. Downside moves faster than upside. The stop needs more room, and the entry needs more patience. That is the bearish engulfing. Sellers take the wheel. Number 7 has exactly the shape of a pattern we already covered and the opposite meaning. It is called a hanging man. Small body at the top, long wick underneath, identical shape. The only difference is where it appears. A hammer shows up after a decline. A hanging man shows up after a rally. Here is what that actually means. In an uptrend, that long lower wick is not a rescue. It is evidence that sellers finally showed up in size. Buyers had to work to close it back near the top. The trend is getting expensive to hold. 3 rules before you trust it. 1. It must follow a clear advance. 2. The wick has to be at least twice the body. 3. The next candle has to close lower, or it means nothing. And the mistake almost everyone makes, reading the shape instead of the location. Shape tells you what happened. Location tells you what it means. That is the hanging man. Same shape, opposite meaning. Number 8 takes 3 candles to end a rally, and the boring one in the middle is the one that matters. It is called an evening star. 3 candles at the top. First, a long up candle, buying in control. Then a small candle that gaps higher and goes almost nowhere. Then a long down candle that closes deep into the first one. Here is what that actually means. The middle candle is the warning. Price reached higher and nobody followed. The third candle confirms that the last buyers were the highest bidders and there was nobody behind them. 3 rules before you trust it. 1. The middle body must be small. 2. The third candle has to close below the midpoint of the first. 3. It has to appear after a real advance. And the mistake almost everyone makes, ignoring the middle candle because it looks boring. That boring candle is the entire signal. That is the evening star. A rally quietly stops working. Number 9 is a rally that failed inside a single candle, and it still counts as a signal. It is called an inverted hammer. One candle, a small body sitting at the bottom, and a long wick above it. Price pushed up hard during the session, then gave all of it back before the close. Here is what that actually means. This is the same shape as a shooting star. The difference is where it stands, not how it looks. After a long decline, an attempt that fails is still an attempt. Sellers had every reason to press lower and did not. 3 rules before you trust it. 1. The upper wick has to be at least twice the body. 2. It has to appear after a real decline, not inside a range. 3. The next candle must close above it. And the mistake almost everyone makes, buying the wick itself. On its own, this candle is a failed rally. Only the candle after it turns a failure into a floor. That is the inverted hammer, a failed rally that still counts. Number 10 is not a reversal at all, and treating it as one is the fastest way to lose money with it. It is called a Bullish Harami. 2 candles. First, a large down candle. Then a small candle that fits entirely inside the body of the one before it. Here is what that actually means. Nothing dramatic happened. That is the signal. After a session of heavy selling, the next session barely moves. Sellers stopped pressing. The absence of follow-through is the information. 3 rules before you trust it. 1. The small body must sit completely inside the previous body. 2. It has to follow a real decline. 3. It needs confirmation because a Harami is weaker than an engulfing, and the mistake almost everyone makes, expecting a reversal. A Harami signals a pause, not a turn. Most of the time, price simply stops falling. That is still tradable, but it is a different trade. That is the Bullish Harami. The move runs out of fuel. Number 11 is the same idea at the top of a run, and it asks you to wait rather than act. It is called a Bearish Harami. 2 candles, and the second one is tiny. First, a long up candle, buyers fully in control. Then a small candle whose whole body sits inside it. Here is what that actually means. Yesterday, the market moved a lot in one direction. Today, it could not even leave the room. Nobody sold hard, but nobody bought either. The move ran out of people willing to chase it. That is not a reversal. That is buying pressure switching off. 3 rules before you trust it. 1. The small body must fit inside the previous body. 2. The first candle has to be genuinely long. 3. It only counts after a real advance. And the mistake almost everyone makes, shorting it straight away. A Harami says pause, not turn. The market can stand still and then keep going up. That is the Bearish Harami. The rally stops talking. Number 12 is the loudest pattern in the course, and by the time you see it, most of the move is already gone. It is called 3 white soldiers. 3 up candles in a row, each opening inside the previous body, each closing near its own high. Here is what that actually means. This is not one buyer. It is 3 consecutive sessions where every dip was bought before the close. Short wicks on top mean nobody was able to sell into strength. That is persistence, and persistence is rarer than a single strong candle. 3 rules before you trust it. 1. Each candle must close higher than the last. 2. Upper wicks should be small. 3. It is strongest coming off a base, not after a long run. And the mistake almost everyone makes, buying the 3rd soldier. By then, the move is extended and the stop is far away. The pattern tells you who is in control. It does not tell you that this is a good entry. That is the 3 white soldiers. The same thing 3 times. Number 13 is the same sentence spoken downwards, and it carries a warning the soldiers do not. It is called 3 black crows. 3 down candles in a row. Each one opens inside the body of the candle before it and closes lower than the last. The lower wicks stay small. Here is what that actually means. Every session opened with hope and closed without it. Small lower wicks mean the dip was never bought. This is not one bad day. This is 3 in a row. Selling that repeats is distribution, not panic. 3 rules before you trust it. 1. Each close must be lower than the one before. 2. Each candle opens inside the previous body. 3. Lower wicks stay short. And the mistake almost everyone makes, shorting the 3rd crow. By then, the move is stretched and your stop sits far above. A pattern tells you who took control. It does not promise you a good price. That is the 3 black crows. The same answer 3 times. Number 14 takes back only half of what was lost, and half is the whole test. It is called a piercing line. 2 candles. First, a long down candle. Sellers completely in control. Then an up candle that opens below the previous low and closes above the middle of that down body. Here is what that actually means. The session started at the worst price of the whole decline. Anyone still short was in profit at the open. By the close, half of yesterday was gone. That is not a bounce. That is buyers paying up. 3 rules before you trust it. 1. It must open below the previous low. 2. It must close above the midpoint of that body. 3. It must not close above the open or it is an engulfing. And the mistake almost everyone makes, accepting a shallow close. A candle that recovers a 1/3 of the body is not piercing anything. Halfway is the rule, and halfway is the whole idea. That is the piercing line. Half the damage taken back. Number 15 does it from above, and there is one measurement almost everyone takes from the wrong price. It is called a dark cloud cover. 2 candles at the top of a run. First, a long up candle, buyers completely in control. Then a candle that opens above the previous high and closes below the middle of that up body. Here is what that actually means. The session opened at the best price of the entire advance. Everyone holding was in profit before a single trade went against them. By the close, more than half of that candle was gone. Buying at the high of the day and closing near the low is not profit taking. It is an exit. 3 rules before you trust it. 1. It must open above the previous high. 2. It must close below the midpoint of the body. 3. It must not close below the open or it is an engulfing. And the mistake almost everyone makes, measuring the midpoint from the high instead of the open. Wicks are not part of the body. That is the dark cloud cover, the best price of the run. Number 16 has no wicks at all, which makes it the easiest to spot and the easiest to chase. It is called a Marubozu. 1 candle with no wicks at all. It opens at its low and closes at its high. Every price it traded on the way up. Here is what that actually means. A wick is a record of someone pushing back. No wick means nobody pushed back. Not at the open, not at the close, not once in between. One side owned the entire session. That is what conviction looks like on a chart. 3 rules before you trust it. 1. The wicks must be near 0, not nearly short. 2. The body has to be large next to recent candles. 3. Read it as conviction, not as a signal to enter. And the mistake almost everyone makes, chasing the close. A Marubozu tells you who is in control right now. It says nothing about where the move ends. That is the Marubozu, a candle with nothing to hide. Number 17 hides everything. Both sides fought and neither one finished. It is called a spinning top. One candle, a small body with wicks above and below it that are about the same length. Price ran up, price ran down, and the close landed near the open. Here is what that actually means. This is not weakness or strength. It is a session where every push got answered. The candle itself is neutral. Where it stands is not. In the middle of a range, it is noise. At the end of a long run, it is the first crack. 3 rules before you trust it. 1. Both wicks have to be there and roughly equal. 2. The body must be small next to the recent candles. 3. The location decides whether it is a pause or a warning. And the mistake almost everyone makes, reading it as a reversal on its own. A spinning top says the market stopped agreeing. It does not say who wins next. That is the spinning top. Both sides, no winner. Number 18 spent the whole session going up and closed at the low of the day. It is called a Gravestone Doji. One candle after a climb, the open, the close, and the low all land at the same price. Above them stands a long wick and nothing else. Here is what that actually means. Buyers took the market up and could not hold a single point of it. Every trade above the open ended in a loss for whoever made it. There is no lower wick because sellers were never under pressure. 3 rules before you trust it. 1. The close has to sit at the low, not near it. 2. The upper wick must dwarf the body. 3. It only counts after an advance. Without one, there is nothing to bury. And the mistake almost everyone makes, calling any long upper wick a gravestone. Where the close lands decides everything. A point above the low, and it is a different candle. That is the Gravestone Doji. Up all day, closed at the low. Number 19 answers a pattern we already covered, and the answer is the third candle. It is called a 3 inside up. 3 candles after a decline. First, a long down candle, sellers still running the market. Then a small up candle that sits entirely inside that body. Then a third candle that closes above the high of the first. Here is what that actually means. The small candle stopped the selling. The third candle proves it was not an accident. Price did not just pause, it took back the whole session that came before it. 3 rules before you trust it. 1. The second body must fit inside the first. 2. The third candle has to close above the first candle's high. 3. It only counts after a real decline. And the mistake almost everyone makes, trading the Harami and skipping the third candle. 2 candles are a maybe. The third one is the pattern. That is the 3 inside up. The Harami answered. Number 20 is the last one, and it is the most expensive kind of confirmation you can buy. It is called a 3 outside up. 3 candles, and the last one is the point. First, a down candle. Then an up candle that swallows its whole body. Then a third candle that closes higher still. Here is what that actually means. An engulfing candle is a claim. The third candle is the market agreeing with it in public. You pay for that agreement. By the time it closes, the low is further away and your entry is worse. What you buy with that price is the trades you do not take. 3 rules before you trust it. 1. Candle 2 must cover the body of candle 1. 2. Candle 3 must close above candle 2. 3. It has to follow a real decline. And the mistake almost everyone makes, calling confirmation expensive. It is expensive. It is also the difference between a pattern and a guess. Entry above the third high. Stop below the engulfing low. So, that is the 20. 20 shapes, and not one of them is a signal on its own. Every one of them asked you the same 3 questions. Where did it happen? What came before it? And did the next candle agree? If you remember nothing else from this video, remember that a pattern is a question, not an answer. So start with 1. Take the hammer, open a chart, and count how often it shows up at the bottom of a move, and how often it shows up in the middle of nothing. That is the work, and it is worth more than another 20 patterns. One pattern a day, 60 seconds each, on the channel.